Dividend growth investors, bonjour, Mike Giroux here. Welcome to this channel where I help you invest with more conviction so you can enjoy your retirement. And today we are tackling the important question, is BCE dividend safe? And we're also going to look at Telus quarterly earnings. So let's get on with BCE earnings that reported 2 weeks ago, roughly. Unfortunately, not many good news as you can see here. So adjusted earnings down double digit, revenue are pretty much flat, the cash flow from operating activities down double digit as well, the capex, capital expenditure, is up 8% and no more free cash flow variation, so we're still at 85 million. So long story short, the company didn't find any growth in terms of revenue, and then cost of operation were higher than expected, generated less cash flow, spent more money on projects, and did not generate a lot of free cash flow. So the first thing that I do when I look at those kind of numbers, I don't start to panic, but I do a little bit more digging. So let's get inside the earnings to see what really happened. So what I did is I went through the press release, the investor's presentation, and the quarterly earnings statement for you to not you to do it, right? So I'm a good guy like this. So in terms of the earnings per share, it was affected by higher cost of interest rate, and also because Bell did a lot of layoffs. It includes several severance packages, and they are also paying those employees for a while before they get off their balance sheet. So we will see those benefits later down the year, but not right now, because when you lay off people, there's still a buffer period where you're still going to have to pay, so it's higher expenses than anything else. The other thing that really bugged me in this quarter though, because the layoff, I think it's a good move in terms of trying to make the company leaner and eventually generate more cash flow from operation with less expenses. But the other problem is the interest rate, right? So I dig into the financial statements to see where the interest expenses stand at. So $416 million paid. That's an increase of 21% versus last year. No surprise here again, because Bell is getting into more debt, and everything that they renewed this year obviously cost a lot more than what they took like 5-10 years ago. So this is a recurring problem. It's increasing and it's affecting the companies big time. At least there were some good news. So the company on the wireless and wireline side is doing actually well. They're getting more users, they're selling more products. So at least that part is a little bit better. So we can see that as Canada is growing mostly due to, or thanks to immigration actually, we see that we have more people getting into like wireless services, getting the wireline, getting cable. So those are good stuff for the future. So there's a little bit light at the tunnel. But in the end, when we look at this quarter, we definitely have to ask yourself, what's going to happen with the dividend? So what happened when there's not enough free cash flow to pay the dividend? As you can see on this chart, so you see that there's a dividend, the free cash flow, and there you go, the debt level. So the debt level is increasing because the company cannot afford to pay for their operation, pay for their capital expenditure, and on top of that, pay for a generous dividend. So even when management feels the pressure to keep increasing the dividend, as they just did not too long ago with another 3% increase for the first quarter, they probably should not have to do that because the company's not doing that well. So from a financial point of view, so it is like giving more money to your children while you did not get any pay raise and your mortgage payment has increased. Probably not the best way to, yes, you're going to keep your children happy, but in the end, you're not improving your financial situation over a short period of time. So you better put things in place that will actually enable you to generate more money down the road, right? Another thing that I didn't really like, and it was coming from the earnings call, so as you can see, I dig a little bit deeper for you guys here, is this last sentence from Mr. Curtis Millen, where he said, we'll look to drive more positive cash flow, kind of like that, deliver paying off debt. I like that too. And restart our payout ratio. So restart a payout ratio. What exactly does it mean? Are you going to try to pull out like a 3M trick where they're going to reset their dividend or something like that? I'm not saying that they're going to cut their dividend next year, but if it keeps going this way, I don't see how Bell would make a good decision to increase their dividend payout in 25. So they must put their things in order and try to shift the business around, because if it's not happening over the next few quarters, I don't see how it would be responsible to increase the dividend once again next year. Finally, when we look at the financial targets for 2024, we see that Bell sees modest growth, so not super exciting here. The earnings per share should decline. The free cash flow should decline as well. So everything is telling you that the situation is not going to increase in the next few quarters. I'm just hoping that we're going to see some positive sign, because if we don't, then I don't see how Bell will increase their dividend. So, last year we downgraded Bell about around February or March of last year in 23 at DSR. We kind of warn our investors saying, you know what, don't expect too much from this company going forward. We're not ready to downgrade it for another notch yet, but it is a possibility maybe later down this year if we don't see any progress into the next quarters. Looking at the financial guideline here, it sounds like it will be downgraded, but I just want to leave the door open for a little longer, because at DSR, I don't think it's important to jump on the trigger right away and then increase or decrease our ratings right up front. We rather have a long-term view, and it is still possible for Bell to switch things around. Now moving on to Telus to see what's going on with Telus. So similar story. Modest growth in terms of revenue. Earnings were down, not as bad, but still with layoffs, still with interest charges. So very similar story in terms of numbers, but for the cash flow, it's a little bit better. So capital expenditure relatively flat, plus 2%. The cash flow provided by operation up by 25%, but the free cash flow decreased a little bit by 26%. So it's not a perfect quarter, but it is still a little bit better than BCE. That also explains why the company went for another dividend increase. We're going to get there in a moment. So they increased it by 3.5%. Their goal is likely to increase it again later on this year. So over the past few years, they have been increasing their dividend twice a year for an average of 7% per year. So 3 point something at the beginning of the year, 3 point something at the end of the year to make up for that 7% year-over-year dividend increase. So again, we do have, when you compare two companies with similar business model, where you're going to get a similar story to tell. So in terms of mobile network, up 3%. So very similar to what happened with Bell. What hurt was healthcare services, agriculture as well, down 1%, down 2%. Those are supposed to be growth vectors for Telus. So instead of going through the classic media diversification, Telus decided to use technology to help healthcare professionals, to help farmers, to manage their crop, manage their equipment. So it is a pretty smart idea in my opinion, but right now it is not delivering what it's supposed to be. So this is where you have the difference between the investment thesis, we have different growth vectors, with the reality, well, those are not growth vectors right now. Those are slowing down the company. What's even worse, Telus International at the bottom of this chart, down double digit, down 10% for the revenue. They are struggling. Their customers are lowering their order. They don't spend as much money with Telus International. The company has been having a very hard 12 to 18 months now. They really feel economic pressure going on, and since Telus is a major shareholders of Telus International, it reflects on their results as well. Again here, I looked into the financial costs, so went from 320 to 394, so up 23%, pretty much in line with what Bell saw that at the same time. So we can see that as debts are being renewed, as the company take on more debt, it is becoming a burden. And at one point, it's not going to be funny, and those companies will have to make decisions. As management from Bell said, they have to delever, so they have to pay off their debt, and they also must find ways to generate more revenue from their activities. Now, is TELUS dividend safe? Well, they just increased it by 3.5%, so I would tend to say yes. The objective of the company is to maintain their payout ratio based on cash flow between 60 to 75. As of March 31st of 24, it was at 91%, so definitely way above a comfortable level. The company still have some wiggle room to increase the dividend, but keep in mind, the company's purpose in life should not be to increase a dividend. It should be to make more money, generate more profits, so it creates value for shareholders, not just through dividends, but also through capital gains. This is not what we're seeing right now. So in terms of cash flow, it was a little bit better than Bell, but overall, we can see that both companies are struggling. In fact, if we look at the dividend triangle, it's not looking that well, right? So both stock price over the past 5 years declined. So down 10% for TELUS, down 22% for Bell. Revenues are increasing, which is a good thing, but the problem is really where we see that into the earnings per share going down very fast. The cash flow profile, as I told you, next quarters, I'm going to continue to look at cash from operation, at free cash flow and capital expenditure. The free cash flow must be able to pay the dividend. It is the case for TELUS right now. It is not the case for Bell, which is a big source of concern for me. What you see at the end of this dividend triangle is the dividend keeps on increasing. So both management teams, they are making that bet that things are going to get better, but is it going to be fast enough? That is another problem. Now, what should you do with Bell? What should you do with TELUS? It really depends on your portfolio. This is where it's important to have a great diversification and not just have companies with this kind of profile in your portfolio. If not, well, if you do, you probably don't have a good year or a good past 2-3 years. It is important to have a balance between low yield, high growth, and good yielders. And in my next webinar, I'm going to show you how you can create that balance and how you can end that buy and sell struggle. So buy with conviction and sell at the right time. This is what I'm going to do with this next webinar. So you can register right there. It's on Thursday, May 30th. The webinar is free. There will be a free replay after that. So if you're watching this video after the May 30th, click on the link and you're going to see directly the replay. It's free for everybody. You're going to receive the newsletters and so on. So it's going to be very interesting. I'm going to also stay for a long hour at least to answer all your questions about any stocks. Before I let you go, I just want to show you one last thing about the impact of interest rate increase. So just for you know, so a lot of people will tell you, oh, but yeah, management says that the interest rate will go down, and then when they renew their debt, it's going to get better and it's all good. So let's imagine that those companies would look for a mortgage instead, and you're going to see the dynamic. So they had a mortgage at $300,000, 2% interest rate, so their monthly payment was like $1,271 per month. All good, everything's fine with their budget, so they go on. Now they expect an increase from 2 to 6% when they renew their debt. So that would have an impact of $661 per month, or up 52%. In other words, you just add yourself another car payment to your budget. Not too sure if you have that room in your budget, right? But then you're gonna tell me, but Mike, don't worry about the 6%. We're gonna get an interest rate cut. It's coming any month now. I'll agree with you. We're going to have likely an interest rate cuts by the end of the year. Some expected to have it bigger and sooner. I expected like a maximum like 0.75 to 1% throughout the year. So imagine that instead of increasing from 2 to 5 to 6%, we increase from 2 to 5. So there's a dividend cut, and then boom, you renew your debt, the same $300,000 at the same debt, and instead of paying like $1,271, you're paying $1,753, so up 482 or up 38%. So even if we have an interest rate cut, those companies will see their debt payment increasing big time. So you have to consider that when you look at those companies struggling with their payout ratios and maybe showing some signs of dividend weakness. So before you make an investment decision, it's important, and I know sometimes it's boring, or you can watch this video, but it's important to dig into the financial press release, financial statement, and the presentation from investors. And if you have some time, listen to the earnings call, especially when you are feeling uncomfortable with a stock. This is where the good information is, and it's going to help you understand what's going on and help you invest with more conviction. All right, I hope that you have enjoyed this video. Let me know your thoughts in the comments about Bell or Telus or any other high yielders these days. Let me know what you think. Give me a thumbs up, subscribe to the channel to not miss my next video next Thursday. And until then, don't forget to stay invested.